Welcome everyone to another week ahead video. This week's video will cover the trading week running from Monday the 15th to Friday the 19th of November 2021. Now in the week ahead, there's going to be a couple of interesting data points. We've got Canadian CPI coming up. We've got UK labor market data, which will be very interesting. And then of course, wage data coming out for Australia, which is also what our week ahead video will focus on. Now, taking a look at the Aussie dollar, it's had a very bumpy ride so far this year. It's been driven lower, of course, by concerns about China's economy, the slowdown we've had in China, commodity prices like iron ore pushing to the downside. We've had the COVID, the lockdowns coming into place in the third quarter. And then, of course, we've had throughout the year, we've had a very dovish RBA. Now, in terms of that November meeting, it had something for both the hawks as well as the doves, because from a hawkish point of view, the bank chose to drop its yield curve control. But at the same time, in terms of the dovish aspect, it's stuck to an overall very dovish tone, pushing back against, strongly against the market's current expectations of hikes lifting off next year. Currently still sitting close to 80 basis points worth of expected tightening going into next year. Now, taking a look at the most recent jobs data, very, very poor across the board. I mean, big drop in the headline, negative 46,000 versus expectations of a print of 50. Majority of that was full-time employment, negative 40,000. Unemployment rate shooting up to 5.2%, the highest it's been since April this year. Even though it was very negative, there were two very important caveats to keep in mind about this print. Firstly, the amount of people moving back into the workforce actively looking for work after lockdowns were lifted added upside to the unemployment report. Furthermore, most of the downside was attributed to the fact that Victoria State, as well as New South Wales, only eased lockdowns in October. So with jobs data expected going forward to see a solid rebound, as well as with CFTC data still showing a very sizable net short positioning in the Aussie, there was very little negative impact for the Aussie with that most recent jobs report. Now, where to for the Aussie dollar from here? There are a few positives and negatives among the key drivers that we still need to focus on. The first one, obviously, like we mentioned, China. We've got commodities. We've got global growth and of course, COVID. Now, when it comes to COVID, recent data has been very encouraging. We've seen new confirmed cases dropping to the downside. We've seen a very, very healthy vaccination rollout, basically going from strength to strength. So that is definitely one less thing for the markets to worry about. Apart from that, incremental positive data points coming out of China recently, not massively positive, but we've had the Caixin PMIs, we had trade data coming in slightly better. The one key laggard though, which hasn't really shown any positives, is the commodity side. Now, when it comes to policy, wages right now is where all of the focus is. The RBA wants to see inflation sustainably within their 2 to 3% target range before they hike rates. And the bank believes that the only way that they can get there is to generate wage growth that is materially higher, aiming for something close to 3%. Now, currently, we're sitting at 1.7%. Now, at the November meeting, the bank said that they are expecting wage growth to pick up gradually as the job market starts to recover. They're expecting the wage price index currently, like I said, at 1.7%. They're expecting this to increase to 2.5% over the course of the next year and reaching 3% over 2023. So with the RBA's relentless aim for higher wages, any significant progress or deterioration in this week's wage growth data will be important, because markets will basically use that as a gauge whether there's a chance of a possible 2022 liftoff in rates, or whether 2023 will look a little bit more likely. Now, the higher than expected Q3 core CPI print that we had a few sessions ago, that spooked bond markets, as you guys know, evidently was one of the key triggers that led to that big push to the upside in bond yields, obviously forcing the RBA's hand to abandon their yield curve target. And even though the RBA is currently, still relaxed about price pressures, given all of the elevated attention we've had about inflation on the global front, especially with US CPI printing, at 6.2% on the headline this past week, this Q3 wage print could spark some very interesting repricing if we see a much bigger than expected push higher, especially with that most recent quarter 3 CPI data also coming in hot. Right now, we can see that consensus is expecting the quarterly print to come in at 0.5, up from the prior 0.4 in quarter two, and forecasting a year-over-year print of 2.2%. Maximum expectation there, 2.2, which is also interesting. And then the prior coming in at 1.7%. Now, a big reason for that big jolt from the previous to the current expectations, a lot of that is down to very, very low 2020 base effect. So that is something very important just to keep in mind. Now, we've had some interesting data coming out. ANZ job adverts printed 6.2% in November, basically reversing all of the lockdown losses. So it's pointing to a solid start for the job market from a demand point of view. The demand is there. And, if the labor market supply remains a challenge, as we've seen in other parts of the world, that could really start to add to some wage pressures, even from the next quarter. It is also interesting just to note that according to RBC Bank, there is a risk that this particular quarter three print might be a bit too early to expect a rebound, because we had both Victoria State as well as New South Wales, like we said, still in lockdowns for the majority of the quarter. And obviously added to that, we had the very low minimum wage hike. And of course, enterprise bargaining agreements, which have for many years kept wages low. All of that has fed into this quarter three print. So we do need to keep that in mind. There is the possibility of seeing a downside surprise. Now, it's important here to reiterate that a lot of the recent negatives, like we've said, China's slowdown, deteriorating terms of trade in terms of commodity prices, the dovish RBA, the COVID lockdowns, a lot of that is arguably already reflected in the price. I think that much is very clear just looking at the most recent CFTC data. It's important to keep in mind that this most recent release of the CFTC data will be delayed to next week, because we had Veterans Day, of course, last week in the US, so the data will be outdated. This was updated on Tuesday the 2nd of November. Sorry, so just keep that in mind. But however, based on the very, very sizable net shorts, I think it's unlikely to suddenly see a large chunk of that already unwound in the most recent data. So I think we should be fairly close to these data points that we saw back with the update on the 2nd of November. So that's important to keep in mind. Now, in terms of possible catalysts and how we can look to trade the Aussie in the week ahead, in terms of hawkish or bullish surprises, the first one is we've got some interesting Chinese data coming up. Any upside surprises in Chinese economic data, we'll expect to see upside in the Aussie. Obviously, downside surprises will be a negative input. We've got industrial output coming up, retail sales, urban investment. All of that will be interesting. Another solid print, or a solid print coming out for this data will be, again, incremental improvements on China's side. We had the Caixin PMIs coming in better. We had trade data coming in very, very good. If we start to see some incremental changes here as well, that can be positive. On the China front, it's also just interesting to note that over the weekend, we had some pretty punchy rhetoric coming out from China, because Australia's defense minister, if I recall this correctly, said that they would likely join or help the US in any type of confrontation with China regarding Taiwan. And we had China actually responding to that, saying that, hey, this is a fight that you need to be prepared for if you want to take on that fight. So we just want to be mindful that even though Chinese data, a positive surprise, they will be positive, we do need to keep that political aspect in mind as well. Remember, the biggest trading partner for Australia is China. After those comments over the weekend, we do need to keep in mind that we might see some, possible trade retaliation coming out from China, or just further punchy rhetoric can also lead to some downside for the Aussie. So we just want to be mindful of that. The data, from the data point of view, a positive surprise will be positive. But if we see any major negative political or trade-related issues coming out between the two, I think that'll largely, overshadow any type of positive data points coming out of China. So that's just very important to keep in mind, that political aspect. Apart from that, the other thing we're looking at, of course, is that quarter three wage growth. So if we see that printing above the market's maximum expectations, we would expect to see upside in the Aussie. Printing below the market's minimum expectation, obviously a negative there. So watching out for a print above 0.6 and above 2.2 for a bullish catalyst, and below 0.4 and below 2% as a bearish catalyst. So that's important to keep in mind. The other one to watch, of course, is commodity prices. We've seen a lot of downside in both iron ore as well as coal prices recently. That has fed negatively into terms of trade, obviously, because it's the biggest exports for Australia. So any type of surprise recovery in these two would be expected to be a positive catalyst for the Aussie, and further continuation, of course, like we said, to the downside in those two, will be a negative from a terms of trade point of view and expected to weigh on the Aussie. And then the other point always to keep on the radar for the likes of the Aussie dollar, any high beta or safe haven, is of course the overall risk sentiment. So overall positive or risk on sentiment expected to be positive for the Aussie. Overall negative risk of sentiment expected to be negative. Now, there's a few options that we can look at in case of a bullish and a bearish catalyst. But given that we think a lot of the Canadian dollar positives are already reflected in the price, as well as staying slightly cautious on WTI, we would look for any possible Aussie CAD upside potential in the event that we get a bullish catalyst coming out. In the case of a bearish catalyst, Aussie Kiwi could be interesting as well, because if you take a look at rate differentials and policy divergence alone, that does still point to a medium-term downside in the pair. The one thing that we just want to stress, again, like we said last week as well, is positioning is still very stretched to the downside. So we would expect any bearish catalyst to be negative for the Aussie, but not expecting that to have as big of an impact compared to positive data due to that net positioning. So think about it this way: because there's a lot of negatives in the price, markets will need to see a lot more negative information to price in a lot more downside, because there's already a lot of downside priced. That means that if we do get positive data, even just slightly positive data, that would be expected to see a slightly bigger reaction in price compared to negative data. So that's always just important to keep that positioning aspect in mind. All right, guys, so that's everything from our side for this week. I hope the video has been helpful. As always, any questions, don't hesitate to let us know.